Question, real estate in California. What the Seriously, can someone help? What's an escrow? What's an ARM? What is an REO? What is pre-approval? Can I get pre-approval? Why is inventory so low? Why are interest rates so high? Oh, interest rates not so high? How low is low? How not so high is right.
Before you go down the road of questions, get expert help at championsofhome.com. California Association of Realtors. Who's your realtor?
Everyone, and welcome back to Real Estate Real and Unscripted with Nicole Miller. I'm so excited to have you back on the show to hear from an awesome guest I have today. Today, we are going to be talking about one element of financing. And so I have with me today, Zach Taylor with Lone Wolf Lending. And he is a mortgage broker who is able to help buyers with all sorts of products of loans. And so thank you so much for being with us here today. Zach, it's exciting to have you.
Yeah,
my pleasure.
Absolutely.
My pleasure.
Glad to be here.
So part of the premise of my show is really about being very educational and how to bring content to the public, not only just realtors, but to the public, and giving them all the information they can. So our show today is just one portion of shows relating to financing options in our sphere in real estate. So we are going to talk today about non-QM financing, and that is basically non-qualified mortgage financing. And so what does that really mean? So you're probably familiar with FHA, VA, conventional, those are kind of the loan programs that are out there, and other shows we have are covering those. But what happens when you don't fit that mold and cannot fit that box? So there are a lot of other options that are out there that, albeit back in the day before CFPB came about and the whole crash, a lot of the stuff back then, a lot of predatory loans happened and things like that. But that's not, this is giving people other options. And back then you had no income, no assets, all this type of crazy loans,
right, exactly.
Which is why things failed. But, there's a lot more regulations in place and really giving options to people that may not fit a perfect box to be able to still have the dream of home ownership and utilizing a loan in the process of that. So Zach's going to be here talking a little bit about that so that you can get some more information. Maybe it resonates with you or someone you know. Maybe someone went through financing and couldn't get approved. Maybe you can hit them up for some, alternative options. So we'll start. So Zach, what exactly is this non-QM lending, like in simple terms?
Yeah, absolutely. So, you hit the nail on the head. It stands for non-qualified mortgage, but really what it is we take a client who maybe qualifies for the loan, but in non-traditional ways. And we use that to actually confirm that they have the ability to repay the loan. So not to, reference like what you were talking about, where the big crash, where you could pretty much get away with anything. And if you had a pulse, you got a mortgage. These are still verifying that the person has the ability to repay the loan, just in ways that don't necessarily fit the cookie cutter or what big banks would generally require it to be done. So it's not sold to the government. It's not backed by the government loans. These are private lenders and private institutions that have come up with their own set of ways to qualify and make sure that the buyers in this case, or the clients in this case, can have the loan, but also we've made sure that there's a way that they can pay it back. We can justify the income, justify their ability to make sure that the mortgage actually gets paid.
So what is one kind of, example of a very typical person or circumstance that ends up falling into that category?
I'd say one of the most important or most common non-QM loans or would be bank statement loans for people that are self-employed. So people who are self-employed, myself, yourself, real estate agents, mortgage professionals, a lot of us, and just really any type of entrepreneur, they do what they can to mitigate their tax responsibilities, lower their tax burden. They take write-offs. They have the ability to take write-offs. And so even though that's good for taxes, it's really bad for mortgages. And so what these bank statement loans do is we take, whether it's 12 months or 24 months of the business's bank accounts, and it can be the owner's personal bank account as well. We take an average of those deposits, and then we take a percentage. Generally, the standard's about 50% of those deposits. But depending on your business model and what it is, we can go up to 80 or 90% of the allowable deposits. And that's how and then we average it over the time that we have the bank statements, 12 or 24 months. And that's how we calculate your income on a monthly basis. And then it gets processed pretty standard, following traditional Fannie Mae, Freddie Mac guidelines for conventional loans from there.
Okay, so they do still have that aspect of it. Like, they'll follow a lot of those standard.
Yeah, exactly. So most non-QM lenders will default to conventional guidelines unless they explicitly allow for something else. Again, how did we come to your income versus reading 200 pages of tax returns or making sure that your K-1s have enough income. Those things aren't needed. In this case, the loan is very similar to a conventional loan, except the way that we're justifying and verifying your income. That's the biggest difference and takeaway.
So non-QM loans, from the buyer standpoint side being an option, are there avenues where a non-QM loan is used exclusive of the buyer's situation that maybe a buyer would have to get a non-QM loan with, maybe condos or certain types of things like that, that default to those non-conventional? So what are some examples of, not necessarily the buyer related? Like I've had situations where they wanted to buy in a certain condo and they're like, oh, it can't go Fannie conventional and blah, 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 because it has a rec lease or, recreation lease is where the recreation facilities or even a land lease where the land it's built on is actually on a 99-year lease. And so there's certain things like that if you want to buy in those properties and go, don't have the ability to do cash, what are some of those outside the box loan options, and what are some of the problems that could happen that are not related to the buyer, but like property specific? Yeah,
it's a great question. Just using it as an example, for back in December 2025, so about 3 months ago, I had a client who's actually a close personal friend, and his wife, who's a real estate agent. They bought a place that the association required them to also become members of a country club. However, the association and the country club have no entity. They have no joint ownership in each other. So they're not any legal ties to each other. So essentially, the HOA is requiring to be a member of the HOA and to buy in the community. You also have to be a member of a non-affiliated third party. Fannie Mae doesn't allow this. So in a lot of cases, if you were going through a traditional bank where they don't have any other options, the loan is denied. You're on your own. Go find something else. What we were able to do is take it from a lender who does conventional financing and bring it over to a lender who does these non-QM loans. And the only thing that wasn't qualified was the property itself. So we processed the loan just like any other conventional loan. But when it came to reviewing the condo's specifics and financials and requirements, this lender was okay with the rest of the loan and just wasn't so concerned about the fact that they needed to, the buyers needed to go ahead and also join this country club as well. So it worked out great. The buyers were able to close on time. The sellers were able to move on to their next, stage of life, and everybody was happy.
So that brings up a really important point. When you work with a lender, who you work with matters. And I think that when, a lot of buyers will get with realtors and the realtors will usually have a lender. And a lot of times buyers will tell me, not even my own buyers, like just in matter of fact stories, like I didn't use the inspector the realtor gave me. I didn't use the lender the realtor gave me. They're all in bed together, right? Like that, like I literally, we hear that, right?
Sure.
But if you're working with a really solid realtor, like if you're working with me, if I'm telling you why I can recommend you, and I don't have one, I have a handful, and it depends on the circumstances of your situation too, right? So like you have a widget for every possible option. Some people are really good at this and specialized in that, and they really know VA loans, and some lenders don't. And why would you give it to someone who doesn't have that familiarity, right? So I will recommend lenders based on that to ensure that your circumstance is handled. And then like any potential issues in your circumstance are also handled. Like, okay, we might have a problem. You're telling me something that, and that's what I feel like a good agent will also resonate with. You have to be able to like see what you're working with. So if you're working with an agent, first of all, let's say this, I'm going to say this again on every show. You are not seeing houses until you are pre-approved.
Yes, absolutely.
Okay. You are not seeing houses until you are pre-approved. I don't care if you are God yourself. I'm sorry, but I have had so many people over the course of my decade plus that came and were super like, I'm good. I know, and I make so much money. I'm in the hills of like a foreign country dealing with a client who gave me that record. And guess what? When the major big bank declined him because the square didn't fit in the hole, the circle, that that died in the water real quick. And
Sure.
I remembered saying, okay, you did tell me that you were W-2 and you became a 1099 and then you had also commission and all this stuff. And and so, of course, at the time, I reached out to one of my lenders and it was like, yo, can you fix this?
Sure.
And they should have gone with them in the first place, right? We had to get an extension from the seller. We had to give them, tell them like, no, don't worry. We're going to get this done, please. So when you're working with a really good agent, and they give you a recommendation for a lender, sometimes, people will also say, well, I'm going to check with Joe Schmo Bank 1 and Joe Schmo Bank 2 because their rates and blah, blah, blah. This guy's got great. Like he has hooked it up. I met Zach, funny story, right? So this is the conversation part.
Right, yeah.
I met him 2 years and change or so ago in a condo community that I sell a lot in. And he had been the lender. No, sorry. We met before that. We met on the condo community in Deerfield.
Deerfield, yeah.
Second was, yes. So Deerfield condo, buyer's agent brought a great buyer. I was the listing agent and, I grilled him and he was solid and we closed and it was all great. And he was able to, it was a condo. Condos aren't easy. And he got it done. And then like a year later, I was, my seller was accepting an offer in a condo community in Margate. They had started the process with someone else. I grilled the someone else. It was solid. It was okay. And then suddenly I get an email that like someone else is no longer there. They picked someone else. And I'm like, oh God, I don't know who this someone else is. And then he reaches out. I'm like, oh, it's you. Okay. So I feel it. Like we were good.
Right.
And that, I mean, we were clear to close in like 10 days or something crazy like that.
Yeah.
And the condo had already been approved. And we'll talk about condo financing on another show. But, I always recommend to people that, don't just look at those numbers. Don't just look at like, oh, I have to shop the rate. Like there's a lot more to be lost other than the rate, and making sure that the person you're working with as well. And one thing too, I was going to ask, what differentiates you? Like, what do you feel like is what you do that you're proud of that makes you different in this industry?
Sure. Yeah, no, that's great. So one of the things that I would say is our pre-approval process is a little bit stricter, right? So it might take an extra 24 hours. That 24 hours is spent making sure the condo, in this case, if the client was looking at condos, is going to be approved or if it's going to be a problem, or if we just don't know, and at least setting that expectation. Getting the necessary documents, getting the, whether it's bank statements or for non-QM lending or just W-2s and pay stubs for a traditional type of client, we're a little bit more thorough up front, and that avoids headaches once money's on the line, once you've had hundreds or if not maybe $1,000+ invested into a property inspection and
appraisal, condo questionnaire, condo approval of application. I mean, you're thousands deep within a week.
Exactly. You're at least, each of those costs at least $500+ bucks each. And so we're trying to avoid those headaches, just like you said, not to be not to go look at properties until you're pre-approved. the reality of it is the real estate agents don't want to take away time from their families and clients who are looking at homes to go show you homes and get your hopes up. And then all of a sudden you just don't qualify.
And that's the thing too. It's not about us.
Yeah.
It's not like
for sure.
People are like, oh, you just don't want to like spend time with me and take me out and you're lazy.
Yeah.
Like, would you go and buy a Rolls Royce at a dealership if you didn't have the money to do it?
Exactly.
Like, why would we do that? And I think the misconception out there is like what people can afford.
Right.
And what they'll be qualified for, but then also married with what things actually cost.
Sure.
So like you might think that you're going to get, a house, you're looking at $700,000 houses because people will come and say like, that's my budget, right?
Right.
So having that, what you're saying as far as doing the pre-approval process more detailed in the beginning, and some lenders will call that like TBD underwriting, and certain direct lenders can actually have the underwriter really like do it in advance. But if you're not able to do that and you work with at least a loan officer that knows very, very well all the ins and outs, a lot of times we find in this industry and even like the bigger banks, people are paper pushers. And that's not anything bad about them. That's just the model that they have as a business. Right. So when you're getting pre-approved at a big bank, the one thing they don't do, and you will see the nuance, and I will never forget this, it was freaking hysterical. I got a pre-approval from a big bank, and on the letter it said, congratulations, Joe Schmo, you may be qualified for a loan up to $500,000. And I'm like, what the heck does that even mean? You may be qualified? Yeah. So if that's a pre-qual. So a pre-qual is a conversation that you have with the lender and they say like, how much do you make? Well, you're like, oh, I make $180,000 and like, okay, great. And like, are they even asking you, are you 1099? Are you W-2? Like all that type of stuff that's important. And then they give you this letter and it says you may be qualified. And then you give it to the listing agent when you're going under contract. And I say, absolutely, I'm not signing off on this to my seller. And then they go to an actual other lender because they want the house and they don't get approved.
Exactly.
They didn't get approved.
You may be qualified also means you may not be.
Yeah. So being, working with someone like Zach that does that due diligence in advance, why on earth would you want to spend 2 or 3 months searching for houses, putting your family in your head in those houses, putting yourself in that price point that you may think that, you need a 4-bedroom house and you're thinking you're going to buy something for $700 and then you go through the process and you're like shaking 4 and 5 and that's also that's not us. That's not us as the person. Yes, of course, that's a waste of my time. And that's why if you meet with a realtor, if they're showing you houses and going on the grand tour to France of all these houses and you don't have a pre-approval, you need to really, really evaluate who's defending you.
And I 100% agree. And which is also where non-QM lending has a good niche, right?
Yeah.
So that self-employed client who thinks, I'm good, I make plenty of money, but their accountant plays Houdini and they don't necessarily pay a lot of taxes on that. This allows them to access the properties that they know they qualify for, that they can pay for, but wouldn't necessarily qualify for with traditional financing at a big bank, or just even with us. We do plenty of FHA, VA, and conventional loans, but they just don't fit that cookie cutter. And this is a huge reason why. Maybe some clients, it is a better option to go directly to a non-QM lender. Or a non-QM loan. It just depends on everybody's individual, circumstances for sure.
Yeah. And working with somebody like you that has that smorgasbord of options that they could choose from, right? That, buffet of options of like, all right, well, we're going to look at this because this is going to give you the best rate and the best, whatever, but it's okay. We can't make this work. And then this is our options. But that's really important because when it comes down to it, one thing on the contract that will hurt you is the loan commitment period.
Sure.
So you have a loan commitment of a certain amount of time. And that loan commitment as of a bunch of years ago has to include the appraisal time as well. You have to get that back as well. And the loan commitment from a realtor standpoint, a good realtor standpoint and a lender standpoint are two different things.
For sure.
So a lender will give you guys a loan approval and they might be able to spit that out in 24 to 7 days, whatever hours
very
today.
quick these days.
Very quick. But what is that? So that was like the underwriting up, and then they give you a list of conditions.
Exactly.
So, one thing I think that's important, when you get those conditions, like what are you doing? Because
right.
You're not giving the loan approval.
Right. And so exactly. And this is where it comes into your question about what makes me and our team at Lone Wolf Lending stand out a little bit is when we submit all the initial documents, again, being a little bit more thorough on the front end will allow us to get that initial loan approval from the lender and have very few, maybe one or two things that we need from the buyer or the borrower, but generally leaving just property things, taxes and title work, appraisal, like you mentioned, because we want to make sure that, again, once that client puts their earnest money down and commits to the seller, I'm going to buy your home, I'm going to do everything I can to get my financing. We want to make sure that we're playing our part in there, and making that a stress-free process is our real responsibility here.
Yeah. So on that note, with like the loan approval timeframe, what I recommend to agents and the consumer out there, if you put 15 days or 21 days or whatever those days are, the loan approval that you get from your lender, if your lender is sending you the loan approval with conditions, that is not the time where your realtor is going to send that to the other side. That is not the time where you're sending it to the other side. You have the ability until the deadline passes to clean that up, make sure everything's good. Yep. So you as a realtor and you as a consumer out there need to have that conversation with your realtor before that loan approval goes to the other side and is considered, hey, we got it, and the deadline passes. We need to make sure that you're having a conversation with the lender. So you're looking at those list of conditions, and buyer related conditions are okay, right? Like, so if there's something that comes up on the loan approval that says, need letter from accountant to verify X, Y, Z and ABC,
right.
I'm not giving that to anyone until that account, because I'll tell you it went wrong a few times.
Sure.
And we're glad that we did not give the letter.
Right. And so again, and that would be where I would say it's important to work with a loan officer, our team, or there's a lot of great ones out there. But a loan officer that is going to ask and say, hey, we need an accountant. We need your accountant to verify that your income is going to be the same or has been the same, especially this time of the year. If you haven't filed your 2025 taxes, we need to make sure that 2025 was still on par with what you had shown in 2024 to make sure that you qualify. Right. Again, that's traditional financing. Non-QM is a little bit more flexible on what's needed, but it's every lender. One of the real differences between non-QM lending and traditional financing is each non-QM lender has their own rules.
Right.
And so what doesn't work for one may just work for another. And if it doesn't work for those two, maybe it works for a third. And if it doesn't work for the third, there is someone out there. Now, whether you as a buyer are comfortable with what that lender may otherwise require, that's a different conversation.
Or qualified. If the rates are higher and your ratios don't work, right? So, yeah. And
so there's a lot of, in non-QM, there's a lot of exception-based lending as well. So these are our rules. But if you have some compensating factors, we'll bend those rules for you too. And it's just, it really broadens the ability to buy real estate and with financing. And so this time of the year, especially if you're self-employed, it's important to be working with your, CPA, your licensed tax professional. I definitely try to steer away from giving the advice.
No, we don't give advice. Yeah.
But when it comes to, like you said, if the difference of you qualifying for a home is not getting aggressive, right? Take what's available to you, but not having the accountant say, hey, I really need to not pay some taxes this year, right? Like Uncle Sam's going to want their money. And so, but again, if you choose to do that, great. No problem.
You could have completely kosher, above board, qualified expenses that you take because you do certain things and you have entertainment numbers that you do, and you do, within code. Listen, we're not giving tax advice.
Right.
You could be taking a solid, your business model may have that you make X amount of money and you have X amount of deductions based on totally legit, no one's fudging anything, but it might put you in a position where if you didn't deduct 10 grand that year and you just ate it and you paid the tax on it, you might now be able to get a different, house or like more than that, right? Whatever the number might be.
Absolutely. And in fairness, if the number is something as small as, not to minimize the amount, what $10,000 is, but really if the number is something small like that, then absolutely. It's when, and I use this example with clients who are self-employed. If you own a grocery store and last year in 2025, your store made $1 million, but between putting groceries on the shelves and paying your employees and paying the utilities and paying the rent, it cost you $950,000. Well, you only made $50,000, and therefore, how could we give you a loan based off of the million?
Right.
That's where non-QM comes into play.
Exactly.
We look at the business bank statements. And
exactly.
We say, they made $1 million. Their expenses don't have to necessarily show or reflect $950,000, and now we can get you a loan. So it's a huge benefit especially for those who are self-employed, not looking to really increase substantially their tax burden. Take advantage of all of the opportunities that are there for them in the tax code with their CPA, with their tax preparer, but then also still buy the home that they know they can qualify for, that they know they can pay for. Otherwise, it's just another way of making sure that their income is reviewed and approved ahead of time.
And there also is circumstances too, through the years I've met people that are like, yeah, I have this job and I do, nails on the side and I do hair on the side, and no one's judging how people pay or don't classify their income. Right. But if you do something on the side and you get cash like that, and you're like, yeah, I can afford it. I make $3,000 doing this second side gig. And I'm like, yeah, but they know you don't, because on paper you don't. Correct. Right. So that's where I was saying things like, that I've met people over the years. They're like, I'm a cleaning person and I make this. No one's condoning that, of course, but like that happens a lot. For sure. A lot. So you might be in a position where people don't necessarily claim as much. That's not an elephant in the room. That's true. Absolutely. So you might, be in a position where you think that you can afford it because you paying $3,000 a month rent. And then you go to the lender and they're looking at what you have on your tax returns and they're telling you you're at like, $2,000
or a loss
or less and,
a loss,
or a loss. Exactly. Yeah. Right. And then you're like, oh, well, then what do I do? And it's like, then could there be possibilities? It's tough. Right. So I think there's options out there, but I think being prepared and speaking to someone who has that whole like Rolodex of options to give you, and then preparing in advance and, making sure that if you wanted to buy something this year, what are your options given your circumstances? And
it's funny you say that, because we even have a program that it's designed for people who definitely have untraditional forms of income, right? So now you don't even deposit it into your bank account. Let's say, and you receive cash, you pay out cash. We have the ability to just take your word on what you're making, have it verified. There's ways to verify it. That might be a whole podcast episode itself, but we can say, and it's stated income, just like it used to be. However, there's a little bit more red tape to get it through it, but 20% down, stated income, and this is how much I made, and now you qualify. Again, maybe there's going to be a little bit of a premium to the rate and the upfront fees, but it's the difference of not having the ability to qualify traditionally and not having the ability to qualify with your bank statements or through other alternative documentation. So there is a way for those as well. It's just making sure that you're working with somebody that has the ability to have access to.
Yeah, I was going to say, so like the major takeaway is, working with someone that does have all those options at their, fingertips to give you any kind of possibility. And then if there's no possibility, coming up with a plan to help you figure it out for the next year.
Right. So no possibility means no possibility today, right?
Yeah.
A no from a specific mortgage lender is not necessarily a no from the mortgage industry, right? There's other lenders out there. There's mortgage brokers like myself who, and again, amazing mortgage brokers out there who have options and available products from their various lenders for people, again, who aren't fitting a cookie cutter, who aren't, don't have perfect credit, don't have 20% down, don't have, maybe have a little bit more debt than, what's ideal. and it's working through those. And then again, if it's a no right now, it doesn't necessarily mean it's a no forever. It's just putting together a plan, working closely with that mortgage advisor and saying, hey, this is what what my plan is, whether it's 3 months, 6 months, a year down the road until something is adjusted and fixed. And then you pick it up and move forward at that point.
Are there different like primary, second homes? Like, can you do this with anything? Investment, primary, second homes? Are there options for? So
believe it or not, investment properties are easier to qualify, right? Because you don't have to show personal income. So if you don't have if you don't have income coming in, or it's not declared, or it's not enough, but you have a large down payment, at least 15%, and decent to good credit, that investment property might be something you could get into without having to do anything else. Whereas primary residences after the crash, 2007, 2008, and then when Dodd-Frank was a few years later, was added, and then ability to repay came in, where lenders are required to explicitly on your primary residences, we have to determine a way for you to repay the loan. It was unfair back in leading up to 2007 and 8. And I was just coming out of high school at the time, so don't blame me.
Me too.
So we were just coming out of high school, but when you hear about those things, and it was like the Wild West, and everybody qualified for a loan.
Your dog could qualify for a loan, anything with a pulse, and
exactly.
And that's also to be said too. That the things have changed.
So that's for the most part is non-existent, right?
Yeah.
Again, certainly on primary residences, there's a lot of red tape. Even private lenders that are lending their own money.
They're very particular now too.
They're going to be very strict. They are likely not going to lend on a primary residence because of the red tape and their requirements as a lender to make sure that you have, again, keywords, ability to repay. That's the most important thing on primary residences. Second homes and investment properties are similar. You would technically get a second home if you were going to live there at least, one day in the year you were going to visit it, and that you didn't need any of the rental income from the property to qualify. So second homes are a little bit more traditionally financed, whereas investments you can use the rental income and your personal in some cases, and then obviously primary residences there's no rental income allowed.
All right,
in most cases.
Is there anything I didn't bring up that's burning inside you to bring up that we might have forgotten before we wrap up today?
Let's think. So we when people think about financing and they talk about buying a home, whether it's an investment property or a primary residence, or they want to buy something in North Florida or in the Keys, the most important thing that they do is get their finances in order. Realize that if they walk into a big bank and the bank says no, there are other options out there. Working with a mortgage broker, working with my team here in South Florida. Again, we're licensed for the entire state. We can do primary residences in the entire state of Florida, but investment properties in 30, almost 40 states through that DSCR program. It's making sure that taking no for an answer on that first no is not something that you do. Like, you want to make sure that you're making sure that there isn't a lender out there that can have that option. You could definitely call us and our team. That is a big takeaway for a lot of, and again, non-QM lenders, for those who are real estate agents, who get an offer and are talking to the loan officer like you do, Nicole. Don't be turned off or taboo just because they say, oh, it's a business bank statement loan for a non-QM lender. Or, oh, we're doing this P&L loan. No, it doesn't necessarily mean anything. You may want to ask a question or two. Has the income already been established? Have they already collected your documents? Probably you would be asking, a quality real estate agent would be asking that anyway.
They should be.
Yeah, they should. Well,
I sent a list of questions.
And I said quality, right? Those are questions you want to be asking anyway. So if it came up that it was a non-QM loan, you're just asking, hey, has the lender who is doing the loan, have they reviewed the income? Have they approved the income? But don't necessarily think that it's a lesser qualified client because they're going with non-traditional type of financing.
Right. So that brings up one, point as well. Like, when I have a listing and we get an offer and we'll get like a pre-approval letter, I will share with my sellers that there's some questions that I've come across. Like, I took my loan test and just never got my license because I was tired and pregnant, and it was just a bad time in my life, and I just never went forward. But I took all the classes and I did everything. And so I'd say, like, I kind of know a little bit more than the average bear. And so I'll ask, and I've also done hundreds of deals.
Sure.
I've seen things go right, left, and, upside down. And so I have like a list of questions that I'll send to the lender in advance.
Sure.
And, and a lot of them are pretty much, they're not giving information they're not allowed to give.
Right.
I will say, as far as like my concern with regular loans, and there's questions that are applying to like the regular Fannie Freddie numbers, like the ratios and what they have to be at, and what did you use for taxes, insurance, HOA. Those are very black and white, but with the non-QM world, it's not like that. So I'll usually like reach out to like you and be like, hey, and I did this week. I was like, so I got this, and like, what should I ask them, like, to make sure that they did their due diligence, because it's out there. Right. So, you want to just make sure as agents that we're not just taking a pre-approval and being like, okay, it looks good. Right. Like, you want to dig into just making sure, first off, that the lender's picking up their phone, that they're available, that they speak intelligently on, I mean, it's funny, but it's not like, I literally talked to somebody and I'm like, oh, good Lord. Like I wasn't getting anything. And so, that's all the important stuff. And then coming back, sharing that with your seller, giving them as much of the feedback as you can, like, hey, they answer, or even like when the lenders email me back and they respond, like, that's even better, because now I have it in writing that you confirm their income, that the underwriter reviewed and it's all in writing. Then you can't come back after and be like, oh, the underwriter said it was a problem. What do you mean the underwriter said it was a problem? You told me in writing that you reviewed it, right? Sure. So I have processes that are a little nuts, because that's just how I am, to try to like dig into things. But at the very least, reaching out, having a great partner lender that you can lean on for other, obviously you use them for other things, but then they help you with, reviewing things for your listings, and making sure that you're letting your seller know all that's out there, that you did as much research as you can, because a paper means nothing. Paper, especially in the conventional world, you can be pre-approved for $800,000, but they did not factor the fact that your insurance is $8,000 or $9,000. Correct. And when you ask them what they use for insurance, they are a loan officer from Idaho, and they told you it was $2,400.
I use the same Idaho reference.
Literally, I had one that was out of state, and he was like, it's about like 24. I'm like, in what century? Like no. And my house has no impact, has no windstorm protection. The roof, blah, blah, blah. We have, I know that because I saw my sellers. My seller's paying right now like $8,000-9,000. Oh, and we're in a flood zone. Like, did you factor that in? And then suddenly that pre-approval means nothing. Zero. So, getting your, putting all of this information in your back pocket so that you can make the right, do the right due diligence for your clients, so that they're accepting an offer that in 3 weeks from now doesn't fall flat. That's the worst feeling, when we're starting all over with something that we could have prevented.
Correct. Yeah, 100%.
And that's the problem too. Like, when you go to those big banks and institutions, and I was, saying this earlier, that they're also like numbers driven. So like, I always tell people, like, you cheat on those companies. You go from one bank, you go to another one. So when they just do that pre-approval, that pre-qualification, that's just a very, shallow level thing, because they're not investing in you. Zero. Because you're going to go cheat on them with 18 different other lenders. And, so why are they going to do that? Yep. So you're getting very, very baseline, shallow, not verified information back from them. So please, like, as a consumer out there, and as realtors as well, we want to make sure that we're helping our clients in the best way possible. If you are working on a pre-qualification that didn't actually have things verified, it's not good. It's not good.
It's really bad.
It's really bad. Yeah, and as a buyer, you think everything is great, and it would really suck that you told your landlord you're not, you're moving. Yeah. You didn't renew your lease, and in the 30-day loan commitment that your godforsaken lender required, because they needed 30 days. Why? Because they didn't underwrite you, and they didn't do anything with your paperwork beforehand. So, while you might think that you're doing the noble thing and they're getting the best rate and all of that, you really have to hedge that with, like, what are the risks that can come with that? 100%. And, working with someone like Zach and the great lenders I have on this show, like, they know their shit. They're going to look at that stuff. They're going to make sure that they're doing as much as they humanly possibly can to avoid these things. There's no reason why we get a denial because insurance was too high and the debt to income ratio was off. Correct. Like, there's no reason. And you want to position yourself in the best way possible so that you're not going to have that heartbreak. 100%. So many funny things spiral after that. It's a domino effect. And so I thank you for joining.
Yeah, this is great.
And I'm so glad that you were able to come and drop some knowledge. And, if you want to share where people can find you, a website or something, if you guys have any questions and, anything resonated with you that we spoke about in this show, please don't hesitate to reach out. Let them know where they can find you.
Yeah. So obviously we're on all of the social medias, Lone Wolf Lending, at Lone Wolf Lending. Our website's lonewolflending.com. And our office is in Weston. So yeah, we're right here in Broward County.
Awesome. So yes, again, thank you for joining me. It was such a pleasure.
My pleasure.
And everyone out there, thank you guys for listening in. I hope you got some great information. If anything resonates, reach out, ask us any questions. And please remember to like, share, because that's really the purpose of this show, to make sure that we share that education and keep everyone knowledgeable. And thank you guys so much again. I look forward to seeing you on the next one.
Spreadsheets, clunky software, 100 different logins just to run your business? Ah.
There's a better way. Odoo. One simple, connected platform that handles sales, inventory, accounting, and more, so you can focus on growing, not juggling. Make the switch today at odoo.com. That's ODOO.com.